Hey there, and welcome back to the Deep Dive. This is where we get smart, fast, by digging into important source material.
That's right.
Today, we're unpacking some really insightful sources, looking for practical ways you can grow your money and generate income. This particular deep dive is really geared towards you, our discerning retail income investors, especially the FinBot Insights community.
hmm
We've got a clear mission today: cut through some of the noise and lay out two powerful investment approaches, ones that could, genuinely make a difference to your portfolio.
Indeed. Our goal today is to explore two strategies. They're distinct, certainly, but also remarkably complementary when it comes to building wealth. And these aren't just abstract ideas, they come straight from the sources provided, focusing on real world application and, very importantly, their historical track records.
Right.
We want to give you actionable insights, valuable perspectives to help you enhance your own investment approach.
Okay, so to really get a handle on these strategies, maybe we should start with a core principle, something fundamental to sound investing.
Good idea.
So John Templeton, who's, a legend, always hammered home the importance of focusing on value, real value, not just fleeting market outlooks or what's trendy.
hmm Crucial distinction.
I mean, think about it. The news cycle is just constant, isn't it? Opinions, market chatter, geopolitical events, local news, even the weather.
It never stops.
Exactly. The market's never dull. There's always something happening. But Templeton's point was, beneath all that surface activity, the market really moves based on underlying financial principles.
Yes.
How do you see investors kind of dealing with that constant flood of information without getting sidetracked?
Well, that's a critical question, actually, because the sheer volume of news, it can easily pull investors off course. It tempts you to react to every single headline. But the importance of focusing on those underlying fundamentals, it really can't be overstated.
What kind of fundamentals are we talking about specifically?
Things like a company's earnings power, the strength of its balance sheet, its assets versus its liabilities, that's the bedrock. This focus gives you a stable, rational framework for making decisions. It's sort of an anchor against the volatility that you get from short-term market reactions to, well, to breaking news.
Right.
Understanding those core drivers means you base decisions on a company's intrinsic worth, its true value, not just the sentiment of the moment.
So seeing past the daily noise to the actual engine driving the value. Okay. Building on that idea then, focusing on that intrinsic worth, let's dive into the first concrete strategy. This is one that lets you generate extra income from assets you might already own.
hmm
We're talking about writing covered calls, specifically on dividend-paying stocks. Now, I know options can sound a bit complicated to some folks,
It often does, yes.
but this specific technique, covered calls, it's actually widely used. Experienced managers, high net worth folks, even big corporations use it for its strategic edge.
That's right.
What is it about this particular option strategy that makes it so appealing for income seekers?
That's a great question because, as you said, many people hear options and immediately think high risk. That's a common misconception.
Yeah.
But covered calls are generally considered the most fiscally conservative of all the option trades. That's a really crucial point.
More conservative. How so?
Well, unlike some other option strategies, they don't expose you to unlimited risk. Why? Because you already own the underlying shares. That's the covered part.
Okay, you own the stock first.
Precisely. You're essentially selling someone else the right, but not the obligation, to buy your shares at a specific price that's the strike price by a certain date, the expiration date. You could almost think of it like selling a temporary insurance policy on your stock.
Oh, okay.
The strategy is really designed to help offset your existing stock risk by giving you a modest, immediate gain. That gain comes from the call premium.
So you're basically getting paid up front for the possibility of selling a stock you already hold, potentially at a higher price than it is now.
Exactly that. And the income generation is interesting because it actually comes from three different places.
Okay.
First, you keep receiving the regular dividends from the stocks you own. That's your base income stream.
All right, the dividends keep coming.
Second, you can still benefit if the stock price goes up, potential capital appreciation, assuming it doesn't rise above your strike price by the time the option expires.
Got it.
And third, and this is the key part for the strategy, you collect that premium. That's the cash you get immediately from the investor who buys the call option you wrote or
Great.
sold. And that upfront payment, it's yours to keep, period. Doesn't matter if the option ends up being exercised or just expires worthless.
Ah, okay, so it's guaranteed income in that sense.
The premium income is, yes. This kind of layered approach to generating income, well, it makes it quite a compelling idea for optimizing returns on equity holdings you might otherwise just be sitting on.
That really makes sense. So for you, the return income investor listening, the real value, the utility here, is generating extra income from stocks you already have in your portfolio.
hmm Adding another layer.
It's like adding another dimension to, say, a traditional dividend strategy.
Mm,
You own a solid dividend stock, you collect the dividend, sure. But you could also sell a covered call against it and collect that extra premium.
exactly.
And you mentioned market conditions earlier. This seems especially useful in maybe sideways or flat markets where prices aren't moving dramatically.
That's often where it shines, yes.
Wow.
Because you're still generating that premium income, even if the stock price isn't appreciating rapidly.
Now, obviously, understanding the mechanics, choosing the right strike price, the right expiration date, that's got to be key to making it work properly.
Absolutely. It requires some understanding and discipline, but it provides a way to actively extract more value from assets you already hold instead of just letting them sit passively.
Okay. Actively managing assets.
Yeah.
Makes sense.
Right. Now, that leads us nicely into the second strategy. And this one, well, it might seem quite basic on the surface, but it's actually overlooked by a surprising number of average investors.
Okay.
And that's simply making sure you incorporate dividend-paying stocks into a well-diversified portfolio. What's often perplexing, frankly, is seeing how many investors seem okay lending money to, say, the U.S. Treasury by buying bonds that yield less than 2%, sometimes for 10 years or more.
Yeah, you see those rates and wonder.
It's a remarkably low return on your capital, especially when you factor in inflation slowly eating away at your purchasing power over that whole decade.
Right, inflation is the silent killer there.
It really is. And accepting those minimal returns passively, it warrants a closer look, doesn't it?
It really does. You know, it's funny sometimes people seem perfectly happy getting almost nothing from a government bond, but then they hesitate to buy shares in a solid company that consistently pays out a portion of its profits to shareholders.
It's an interesting psychological point.
The alternative, and arguably often a much better decision long term, is to thoughtfully allocate that capital into a diversified portfolio, specifically focusing on stocks that pay dividends. And this isn't about just chasing the highest possible yield regardless of risk.
No, absolutely not.
It's about making sure your holdings consistently include assets, strong companies that provide those regular dividend payments. Shifting perspective that way can unlock significant value, especially when you look at the history.
The historical performance data is quite compelling here, really compelling. Think about this. Over the last 50 years, if you took the highest 20% yielding stocks within the S&P 500 index.
Okay, the S&P 500, that's a big chunk of the U.S. market.
Yeah, a huge chunk. Represents about 80% of the investable U.S. equity market. So those top 20% yielding stocks, they returned an average of 14.2% per year.
14.2% per year.
For 50 years.
That's the figure. Which effectively means an investor could have doubled their money roughly every 5 years just by consistently following that kind of strategy.
Wow. And what's more, if you had been even more selective, maybe focusing just on the 10 highest yielding companies in the S&P 500,
The top 10?
the actual annual total return bumps up even higher to 15.7%.
Okay, those numbers really do speak for themselves, especially when you compare them to, say, that sub 2% bond yield we talked about.
Precisely. It powerfully underscores the potential of a well-researched, dividend-focused approach versus more traditional, lower-yield income investments.
You know, that really brings to mind Benjamin Graham. His wisdom in The Intelligent Investor, a book Warren Buffett always credits as being hugely influential.
A cornerstone text.
Graham famously said something like, invest only if you'd be comfortable owning a stock, even if you had no way of knowing its daily share price.
Ah, yes. Such a powerful statement.
It's not just about being patient, is it? It feels like a really strong technical reminder about valuation.
Exactly. Conviction based on fundamentals.
If you understand the company, its earnings, its assets, its prospects well enough that you could hold it without obsessively checking the ticker every day.
Then you've likely done the real work.
Yeah, you've probably done the deep work to assess its actual intrinsic value. It forces you to focus on that inherent worth, not just the day-to-day market swings or the latest headlines.
Graham's insight is truly about that conviction, built on understanding. And, to add some more data on just how important dividends have been historically,
Please do.
Fidelity Investments did a study looking back quite a way from 1930 all the way to 2010, and they found that a really substantial portion, 44% of the total U.S. stock market return over that entire 80-year period, came directly from dividends.
Almost half the return was just from dividends.
Almost half, and in certain decades like the very turbulent 1970s.
Right. High inflation then, too.
Exactly. During the 70s, dividends actually accounted for an even bigger slice, an astonishing 71% of the total returns.
That'd be 1%.
It really highlights their consistent power, their role in overall performance, acting as a kind of buffer, especially in challenging economic times.
Okay, so dividends clearly matter. A lot.
Undeniably. Now, when you receive those dividends as an investor, you face a key choice.
Okay.
You can either take them as cash, use them for immediate income, maybe cover living expenses, which is perfectly valid, or you can reinvest them, put them back to work, buying more shares, harnessing the incredible power of compound interest.
Ah, compounding. The snowball effect.
Precisely. Albert Einstein himself supposedly called compounding interest the most powerful force in the universe.
High praise.
It is. And it follows logically, then, that one of the most effective ways to get that compounding working for you is to invest in great companies that not only pay steady dividends,
All right.
but also have a track record of consistently increasing those dividend payments over time.
So not just getting a dividend, but getting a raise on your dividend.
Exactly. That dual benefit offers both current income and potential for significant long-term growth. It's not just about the starting yield, but the quality and the growth of that dividend stream, which usually reflects a strong, profitable underlying business.
Okay, so let's try and wrap this up. Summarizing our deep dive today, the key takeaway seems pretty clear. Both of these strategies, writing covered calls on a diversified portfolio and strategically including high-quality dividend-paying stocks in that portfolio, these are smart, accessible approaches. They seem well within reach for any investor who's looking for, meaningful wealth growth and that consistent income generation.
Absolutely. These aren't techniques reserved only for the Wall Street pros. They're practical approaches that, when you understand them and apply them with some discipline, can be used effectively by retail investors like you.
Right. Not overly complicated, but requires understanding.
Precisely. And maybe, as a final thought, something provocative for you to mull over.
Okay, let's hear it.
Just consider how these two strategies, which are both fundamentally conservative and income-focused, how they might work together. Imagine combining them, harnessing those dividends for a steady cash flow.
Oh, the base income.
And then layering covered calls on top of those dividend stocks to generate additional premium income, maybe boosting returns, particularly in those flatter markets we discussed.
An integrated approach.
Exactly. Could such an integrated approach significantly alter the risk-reward profile of a traditional income portfolio? Could it potentially unlock greater returns and enhance stability, even when market conditions get choppy? Something to think about.
That is definitely food for thought. Combining the two for potentially better, more stable results.
Okay.
Well, this deep dive was put together specifically for you, the Finbot Insights audience, aiming to give you actionable financial intelligence. If you found this discussion valuable today, we'd really appreciate it if you click that like button. It helps others find this content. And of course, to make sure you don't miss out on future in-depth analyses of financial strategies like these, please do consider subscribing to the channel. We sincerely thank you for your time and engagement with us here on The Deep Dive.